All right, everyone. Welcome to Chapter 8, Brief Exercises. Let's go ahead and get started. Brief Exercise 8-1, advance $10,000 to an employee. That would be other receivable. Receivables because we're not loaning it to a customer, nor are we making a loan. We actually advanced it to an employee, so it's others receivable. Received a promissory note of $34,000 for services performed. That is loaning $34,000 to a customer, and that would be notes receivable. And then he is sold merchandise on account for $60,000 to a customer. So that's actually, we sold the merchandise for $60,000 to a customer. So that'll be accounts receivable because we'll receive that $60,000. So right. All right. Next is brief exercise 8-2. Record the following transactions in the book of Crane Company. Omit cost of goods sold entries. Credit account titles are automatically indented. Actually, won't be indented on here, but they will be on your homework when you do it. So I already put the dates in here to kind of speed it up. On July 1st, Crane Company sold merchandise on account to Stacy for $25,200, terms 4% within 10 days or net 30. So what we'll do is we'll do accounts receivable. Because we sold the merchandise, we will receive that, so we need to document it for $25,200. And then we also need to do sales revenue. As a credit for $25,200. July 8th, Stacy Incorporated returned merchandise worth $2,500 to Crane Company. So this will be sales returns and allowances. For $2,500. And the accounts receivable. All right, July 11th, Stacy Incorporated paid for the merchandise. And they received a discount of 4% because they were paid within 10 days. So first one will be cash. Actually, these will be the three accounts: cash, sales, discount, and then accounts receivable. Accounts receivable is $22,700. The sales discount will be $22,700 times 4% equals Should be a discount of $908. And so the total cash we will receive is it'll be the accounts receivable minus the discount we gave them, which would be $21,792. Moving on to 8-8. This one's a fill in the blank. This will just be filling in the missing amounts. So the maturity date, we just have to count the days, just look on the calendars, plus 60 days will be May 31st, maturity date for that one. July 2nd, 30 days would actually be August. And March 7th plus 6 months, and so we count from March to April, April to May, May to June, June, July, July to August, August to September, so September 7th. Right, here's all the amounts. I'm going to change this. Just for visual purposes, 0.0. Mind. Keep that on there because that's actually how it is on the homework. I'll just change it down below when I do the homework, do the problem. So $648,000. So this one equals this $648,000 times 0.09. That's 58,320. And then the term was 60 days. So we times this by 60 days is actually 2/12. $9,720. All right, let's go ahead and dive right into this one. This one, and do it. I just actually did it kind of a backwards way. It is 9%. And what I did, and then I just checked it. So I did 900 times 0.09. 30 days would be 112. $181 rounded to the nearest 0 decimal place. So I checked that one. That one's 9%. I'm sure you guys will have the right algebra to figure that out, but I kind of want a backwards way to do that. Okay, so moving on, 113,270. 70 do equals is times 0.1, which is 10% up above here for the annual interest rate. And then we got to times that by the fraction of how many days. So 6 months is 1, or we could do six months out of 12 months divided by 12. That should equal 5,663. $50. Make sure you put all the zeros. I would change the format, but I'm just gonna go ahead and put it in to save some time. All right. Moving on. So compute. So here's the. I'm gonna go ahead and cut this down. Sorry, guys. All right, so brief exercise 8-11. Suppose the 2017 financial statement of 3M Company report net sales of $25.2 billion. Accounts receivable are 3.5 billion at the beginning of the year and 3.01 at the end of the year. I put the formula down here. So receivables turnover ratio equals net credit sales over average net receivables. So first things first, let's get the average net receivables. We'll do 3.5 plus 0.01 divided by 2 plus 3.255. And then what we'll do is so the total net sales was 25.2, and they're all billion. So let's take this equals, and then divided by, and then your answer will come out to 7.7419. And then you need to round it to the nearest decimal place right here. It says to the 1 decimal place. So your answer will be 7.7. All right, next question. Compute 3M's company's average collection period for accounts receivable in days. round to 1 decimal place. Use 365 days for calculation. Average collection period. Enter the average collection period in days rounded to 1 decimal place of days. All right, so what we'll do is we'll take the company's receivable turnover ratio is 7.7, and then we'll actually take 365 divided by 0.7, and we'll get 7.4. So we round it to the nearest decimal, 47.4 is your answer. All right, moving on, 8-10. So Marigold Corporation has the following transaction related to notes receivable during the last 2 months of the year. Company does not make entries to accrue interest except at December 31st. So we'll just do interest up to the 31st. Net cost of goods sold entries. All right, let's get going. So November 1st, loan for $54,000 to CBOR on 12-month, 8% note. So count that it would be notes receivable. And then the other account would be cash. And we're going to debit 54,000 notes receivable. And then December 11th, sold goods to KR Pine Incorporated, receiving a $7,200 90-day 9% note. So this would be notes receivable, 7,200, and the other account would be sales revenue. And then we're going to credit this for 7,200. On December 16th, received a $12,180 day 7% note to settle an open account from a Murdoch. All right, so December 16th would be notes because it is a note, we're loaning them money. And then the next one would be accounts. So the notes receivable would be 12,000, and accounts receivable would be 12,000 as well. December 31st, accrued interest revenue on all notes receivable. All right, this one was probably the most challenging one for me. But let's go ahead and get started. So we need to add all this up. So 54,000. So this is 54,000 times 0.08. And then you have to times by how many months. So November 1st to December 31st. So that's 2 months. 8. So that'll be 2 months of 12. So it'd be 2/12. It'd be $720 in interest. All right, the next one is $7,200, 90 days, 9% note. So let's go ahead and 7,200 times the interest, which is 0.09, times 90 days, which would be, we'll do, it's actually not 90 days. So December 11th is, so it'd be 20 days. So it'd be 20 divided by 360, and then we'll get $36. And then $12,000. So the next one is $12,000 at 7% interest. And then so it'd be 0.07 times. And then what I found actually is the 90-day and the 120 days up here, the 90-day, 180 days was actually kind of confusing. So don't pay much attention to that. Just pay attention to how many days until the 31st. So this one would be 15 days. So it'd be 15 divided by, that's $35. So we add all these up. And $791. So go ahead and do interest receivable, and then we're going to debit that $791 because receiving that additional money. And then we're going to do the other accounts involved as interest revenue. $791. And that's your answer. 8-11. All right, let's get this knocked out. So receive $3,700, 12 months, 3% note in exchange for an outstanding accounts receivable from R. Stoney. May 1st would be notes. And then we're going to debit for $3,700. And then the other account involved here is accounts receivable. And we're going to credit that side first, $3,700. All right, December 31st, accrued interest revenue on R. Stoney's note. R. Stoney. So this one will be interest, similar to the last exercise. So we'll calculate that in just a sec, and then interest. So 3,700. What we'll do is we'll do 3,700 times see. So May to June, June to July, July to August, August to September, September to October, October to November, November to December. That's 7 months. So the interest is 3%. By 7 divided by 12. And that's not the right answer, so don't. So May to June, June, July, July to August. Actually, it's only May, June, July, August, September, October, November, 8 months. That's actually $74 for that interest. So we'll go ahead and do that. Debit interest receivable for 74, and credit interest revenue for $74. All right, received principal plus interest on R. Stoney's note. No interest has been accrued since December 31st. Okay, so we're going to take basically from January to May 1st to round this off. So there will be 4 accounts involved here. So let's write them all down. Cash, notes receivable, interest receivable, and then interest revenue. All right. So first things first, we have to calculate the rest of the month. So January, February, March, April is 4 months. So what we'll do is go ahead and just change this to 4 out of 12. So this is from January to May, 4 out of 12, would be $36. So that would be interest revenue would be 37. Interest receivable would be 74 to balance out the interest receivable on the debit side. We have to do it on the credit side. And then notes receivable would be for the full amount of 3,700. And then total cash, we just have to add up all these. Here. Why don't I just leave it over here? Sum of all these, $3,811. All right, we're almost done. 8-6, A. All right, this one's a little bit lengthy, but we'll get this knocked out quick. Let me know if you guys have any questions, as always. So on January 1st, 2007, Crane Company had accounts receivable of 57,600 and allowances for doubtful accounts of 3,900. Crane Company prepares financial statements annually. During the year, the following selected transactions occurred. All right, so January 5th, let's get started. Sold $3,900 of merchandise to Ryan Company, terms net 30. That'd be accounts. accounts receivable, and then sales revenue. And that's for $3,900. So February 2nd, accepted a $3,900 4-month 10% promissory note from Ryan Company for balance due. So it'd be, since receiving, basically giving them a loan, so notes receivable. $3,900. We won't calculate the interest yet. So any other ones accounts. And we're going to credit that side, $3,900. February 12th, sold $13,140 of merchandise to Cato Company and accepted Cato's $13,140 2-month 10% note for the balance due. So what we're going to do on that one is notes receivable, because we're making another loan here. So it'd be $13,140. And then the next one would be sales revenue. And we're going to credit this side for sales revenue for $13,140. Moving on. So February 26th, I mean, you'll have to put these dates in, but I just put them in to speed it up a little bit. Sold $12,400 in merchandise to Malcolm Company, term net 10. February 22nd is the for 12,400. And the next one would be sales revenue. And then we're going to credit this for 12,400. All right, April 5th, accepted a $12,400 3-month 7% note from Malcolm Company for balance due. So we're basically just gonna do another loan. For April 5th. That would be $12,400. And this would be accounts receivable. These are all accounts receivable because we're receiving, well, not all of them, but all of these notes receivable are accounts receivable because we're giving away or we're selling merchandise. And hopefully we'll receive the money. All right, so April 12th, collected Cato Company note in full. All right, so here's the accounts involved in this one would be, so we're receiving money finally. So it's cash, notes receivable, and interest revenue. Not indented, this one's supposed to be indented too. All right, so notes receivable, it was debited. We need to receive $13,140. We need to calculate the interest on this, which, let's scroll up, be 2-month 10% note, and they paid us in 2 months. So February, March, March to April, that's 2 months, 10%. So what we'll do is we'll do equals 10%. So times 13,140 times 10% times 2 months. So 2 divided by 12. It would be $219. So we add, so the total cash will be notes receivable plus interest, which is 1 plus the interest, $13,359. All right, June 2nd, collected, you know what I'm gonna do? Bring this down here, see it. All right, so June 2nd, collected Ryan Company's note in full. So we got some more cash. See some more cash. 40, 30. Sorry. Let's do the accounts. Cash, notes, receivable, and then interest, revenue. These should both be indented. Automatically, it will automatically do it, of course, with your software online. All right, so notes receivable is 3,900. So we need to calculate the interest for June 2nd Ryan Company, which is right here. The 4-month, 10% promissory note. So it was paid in February to March, March to April, April to May, May to June, 4 months. So let's find out how much interest they owe us. Equals the amount that was loaned through a promissory note times 10%. How many months were they? 4 months, so 4 divided by 12. $130. So total cash is notes receivable plus interest. $4,030. All right, so last but not least. All right, so June 15th, sold $2,100 of merchandise to Jerry Incorporated and accepted $2,100 6-month 4% note. So we're only going to do notes receivable and sales revenue. We won't calculate the interest because we haven't paid the interest back yet. Notes receivable, 2,100. And we're gonna debit that to 2,100, and then we're gonna credit sales revenue 100. That's it. Let me know if you have any questions.